Okay, trading psychology is a serious factor that has an immense impact on the efficiency of trades and strategies. And despite a common misbelief, the best traders are not the ones who studied all the books and indicators. They owe their success no less to emotional control than experience. So in this video, we will discuss the major problems experienced by traders and how the effect of emotions can sabotage your profits. You will learn about productive and disruptive personality traits, recommendations from experienced stock investors, and you will find out how to improve your trading psychology. But first, of course, let's roll a quick intro and then we will go straight to the topic. Trading psychology is a combination of a trader's reactions to events taking place on the market. This is what reflects the nature of our trading decisions. Traders can react differently to the same event. For example, with a sharp drop in the value of shares, some beginning to panic and urgently sell off assets. Others, on the contrary, prefer to buy stocks at a low price, resting assured that the stock value will bounce back and that their purchase will be justified. The attitude to market news and events clearly shows the difference in trading psychology. Based on behavioral patterns, the following psychological profiles of traders can be distinguished by 1. The impulsive one. So such traders are not inclined to be patient or think about their trading strategy for a long time. They open deals on the spur of the moment without thinking much about the consequences. Any change in the market is a signal for them to act immediately, and such traders are most affected by emotions and often make rash trades. The second one is cautious. This is exactly the opposite of the previous type. A cautious trader weighs his every trading decision by conducting a complete and comprehensive analysis, studying the opinions of other traders and financial experts. While such traders are hesitating, the moment for a successful deal may be missed. Cautious people are better off being long-term investors than traders. The third one is practical. Such traders successfully combine the qualities of the previous two types. They know well how to manage risks and don't hesitate when making a trading decision. This approach is best for working on any exchange. But as you might guess, the last type is the rarest one. Sticking to the golden middle is hard. However, in the next sections, we will describe ways to overcome greed, fear, and hesitation. So now, how to improve your trading psychology? By assessing your own strengths and weaknesses, which is the key to mastering strategies that suits your personality. Traders are affected by their emotions, biases, and personality traits. When you acknowledge them, you will be able to elaborate a trading strategy enhanced by your positive sides. At the same time, you can find ways to tame your fear and greed. For example, if you are a confident person, you can make rash and risky decisions. You can decide not to set stop losses because you're sure that the asset's price will turn in the expected direction. To avoid such mistakes, traders recommend setting strict stops and take profits. This way, you will make conscious decisions that are less affected by your emotions. What affects trading? There are several emotion killers of traders' efficiency. Number one is fear, because fear is the main enemy of traders. It can force people to close a profitable trade ahead of time or get rid of promising assets when they temporarily drop in value. For example, when the market goes against a trader's prediction, he can put a stop loss closer, comforting himself with the thought that this will increase the stability of the trade. This is not true. In any case, if we try to stay away from the risks that we originally planned, we are acting against our trading plan. Our behavior is emotional, so make sure to close a position when a certain goal is reached. Emotional trading always leads to loss of capital in the long run. So then there is the fear of missing out, the popular FOMO, which is another widespread phenomenon in trading psychology. It is often observed during major market uptrends when people start regretting not buying certain assets some time ago, as it happened with Bitcoin. However, opportunities pop up every day and traders should learn to distinguish them. Here's how the FOMO cycle evolves together with an asset's price. If an investor is guided by someone else's opinion, he cannot rely on his own critical thinking. Meanwhile, the latter is the main skill of a successful trader. And to understand the market, always have your own opinion and take full responsibility for your decisions. Do not copy someone's profitable trades and do not collect the same investment portfolio as any famous trading guru. But I need to add, at least not until you understand the basis and agree to the principles behind the reasoning to make such trades. Remember, everyone has their own thoroughly developed strategy, clear goals and perspectives. Not everyone is equally willing to take the risk of losing money. Therefore, it is not always worth imitating other traders, but you can listen to their opinion. So the next one is greed, which is another emotion that can hinder profits. Spontaneous trades made for big profits very often turn into equally big losses. The desire to get everything at once while paying no attention to high risks pushes traders to rash transactions. For example, greed can force you to set a very high take profit for no reason. In such a case, you risk missing a breakdown of an important resistance or support level. This mistake is most often observed among experienced traders, and they become victims of overconfidence and stay assured that the market will move in the expected direction. That makes them risk higher volumes. Greedy trading is similar to casino gambling. People keep increasing the stakes with their mind clouded by hopes and wrong expectations. If you are ready to put large volume at stake, but this does not correspond to your trading plan, you can try creating another account or opening separate deals to test your theories. Next is bias, because biased trading takes place when you're inclined to open positions in favor of some certain assets. As a result, you can start making less efficient trading decisions and base your choice on personal preferences instead of technical or fundamental analysis. And as a rule, traders have a biased attitude towards the asset they had past success on. They will keep picking it again. On the contrary, stocks that brought losses are avoided, of course. It is crucial to be aware of your biases and stay guided by a rational mindset and market research. Bias can also manifest itself in the following situation. One is negative thinking, when the trader pays too much attention to risks and tends to see the danger everywhere. This can lead to the closing of a profitable trade even if it develops according to the expected scenario. It can be also an ignorance of market conditions when the trader tends to continue using tested strategies or markets without taking into account new information. This may work for a while but will hinder the trader's success when the market is changing. Then we have things like confirmation bias, which happens when a trader seeks or exaggerates the value of arguments that confirm his pre-formulated ideas. At the same time, he will turn a blind eye to the facts that refute his beliefs. Then we have biased assumptions that are related to the asset cost. For example, when the price has already risen, a trader thinks that it will continue to rise. The opposite opinion, if the price has gone down, then it must fall soon, has no ground until proven by technical indicators. So such reasoning often underlines failing trades. In other words, you assume that things will happen which are best for you, not even trying to see other approaches or other possible scenarios. So next are snap decisions. No matter how experienced a trader is, his decisions should be based on a throughout market analysis. Assessing the trend on a given time frame is a must for successful trading. You can destroy your long-term financial result by ignoring the rules of risk management. Before opening any trade, make sure that you stick to the well-balanced risk-reward ratio. Then is identifying one's mistake. So after losing money, some traders are unwilling to admit that their actions led to failure. They start blaming the market instead. As a result, they keep repeating the same mistakes over and over again. It is caused by inability to admit losses. Traders refuse to take losses so as not to hurt themselves. And the psychologists assume that loss aversion is connected to the instinct of self-protection. But in the financial market, it is vital not only to endure the pain of losses, but also accept them neutrally, since failures are inevitable and trading always comes with a risk and a high profitability of loss. You need to be prepared for this and have a backup plan in case something goes wrong. Make sure to set a stop loss for every deal you open. Otherwise, you may witness the asset price going in unexpected direction and hesitate to close it because you don't want to lose money. This is not a professional approach. So now we will discuss 7 tips to avoid emotional trading. Even if you are a highly emotional person, you can master the certain trading strategies and manage your deals successfully. Here are some recommendations that will help you keep your trading psychology under control. First one is take a personality test. Determine your strengths and weaknesses. You can find them online for free. And the sooner you do it, the better. You need to honestly answer the questions and figure out how to increase the advantages and control the disadvantages of your mindset. So this is a crucial factor for mastering the psychology of stock market trading. It's important to realize and admit any impulsive tendencies if you have any. So for example, some traders act out of frustration, fear or greed. In this case, you should keep these personal traits under control when you're trading actively. Otherwise, you risk making rash decisions that lack an analytical background. At the same time, you should know how to exploit your personal strength. For instance, if you are a patient individual, you can open long-term positions and wait for the perfect timing. Next thing is to develop a trading plan and follow it. We discussed it 100 times here on this channel, but let's go through it again. Your trading plan should contain detailed instructions for any situations that may arise during trading. When to enter a position, when to exit, what is your budget, how to control risk, and which strategies to exercise. For example, you can decide to trade for a couple of hours in the morning and never stake more than 2% of your budget in a single deal. This way, you can minimize your losses and restrict the impact of emotions on your trading decision. You will see clear conditions and rules for opening and closing positions. Your trading plan should also be based on the specific of your trading psychology. Mind your biases, which we talked about, the emotions and personality traits when crafting a comfortable strategy. This way, your efficiency will be affected by emotional factors to a lower extent. And finally, it is important to keep improving your strategy. Your trading psychology will evolve as well. Then remember to be disciplined. Have enough patience to stay out of the way when emotions push you to enter a position. Stay determined to act when emotions tell you to wait, and close a position when the market conditions are adverse. Also, don't forget that devoting a certain amount of time to trading means getting experience. The more you practice, the higher your chances of closing deals successfully. Okay, now let's talk about what is important to handle wins and losses appropriately. A series of losses and profits is an integral part of a trading career. The secret of a sustainable trading psychology boils down to adequate reactions and your attitude. So after a series of unsuccessful trades, do not rush to recover from losses. Just take a break. You should try to gather your thoughts and get yourself together. Regard your failing deals as lessons and learning opportunities. Take the time to think over your losses, analyze your strategy and find out how to avoid mistakes in the future. It is equally important not to fall prey to the illusion of being a trading god. After a series of successful deals, of course. You may be blinded by euphoria and miss the moment when the market trend reverses. It is common for traders to have many successful trades in a row. Some of them continue trading because they assume that the market will keep moving the same way under its own inertia. When you notice yourself thinking this very way, stop from diversifying your portfolio too quickly and analyze the market once again. You should be perfectly aware of what drives your trading decisions, your own beliefs or facts and technical analysis. So while you're studying charts, try to be cold-headed and think of what might be impairing your trading psychology. Let such emotions as fear and pride cool off before opening the next trade. And very important is to exercise patience. No matter what market you prefer, cryptocurrencies or precious metals, it's important to stay patient to fulfill your plan. Acting on emotions can lead you to miss out on profit by closing a profitable position too early. If your decision is based on thorough analysis and the market evolves as expected, don't bide your time. Let your predictions actualize. And at the same time, it's crucial to stay patient when the market is moving sideways and you cannot find a lucky moment to jump into a trade. Remember that 70 to 80% of the time asset prices are moving within a narrow price tunnel, but even non-volatile stocks are caught up in a trend sooner or later. In order to define the best time for trading, choose particular markets and keep monitoring news. As a rule, price trends are triggered by geopolitical events, news and financial announcements. As a beginner, you must remember to not hurry to diversify your portfolio. It is connected to the previous point about patience, because although diversifying a portfolio can act as a hedge, if the value of an asset drops, it is not recommended to open too many positions in a short time. While the potential gains may be greater, owning a diversified portfolio requires a lot more work. Indeed, you should stay informed about news and events that could affect the markets, but this extra work may not be worth it, especially if you don't have a lot of time or are just starting out. So for beginners, this emotional and intellectual load may be too huge to process. On the other hand, a diversified portfolio increases your exposure to potential positive market movements, which means you could benefit from trends in a large number of markets rather than waiting for a single market to move in your favor. So keep adding assets one by one, increase your trading complexity gradually. Next key thing is understand what leverage is, because increasing your profits by 5 times, 10 times or even 20 times sounds very alluring. However, leverage is not for the faint of heart. Here's why. Leverage is basically a loan made by a broker to open a position. Investors deposit funds called a hedge and gain market exposure equal to the full value of the position. However, while leverage can increase gains, it can also magnify losses. It is important to fully understand the consequences before opening a position. Investors with limited knowledge or leverage can decimate the entire value of their trading account due to excessive losses. And to avoid this mistake, you should educate yourself on trading with leverage on CFDs and similar tools, because this is a very tricky thing. And another one which was discussed many times is to keep a trading log. In your trading journal, you can write down your wins and losses as well as your emotions and doubts experienced during the process of trading. This information can help you analyze your trading psychology and reveal weak spots and errors that should be avoided. Taking a retrospective glance at your actions is important. You can see which decisions were right and which were wrong. Plus, you can track the evolution of your emotional control and find out whether your feelings cloud your judgment or not. As an alternative to writing, you can try recording videos to watch yourself later. If you have experienced traders among your friends, ask them to assess your progress and give some recommendations for improving your trading psychology, because their opinion will be unbiased. Then next, you should be adaptive. Any financial market is ever changing and you cannot expect it to evolve by one and the same scenario over and over again. 100% winning strategy simply does not exist, remember that. You should always keep tabs on the market to adapt your strategy correspondingly. If the market is too volatile, you had better postpone your trading activity and try to figure out what's happening. Being adaptive means taming your emotions and being able to assess the situation regardless of your feelings. Stay pragmatic no matter what's going on around you. So finally, concluding the video, there is a common stereotype that trading on the stock exchange is very difficult and financial intelligence is the major determinant of your success. However, trading psychology and the ability to control your emotions are no less important. Fear, greed, and inability to accept losses can sabotage your efforts. Once you learn to control these emotions, your trading psychology will be greatly improved. So that will be all for this video. Thank you for watching, guys, and I'll see you in the next one.